My goal here is to go through this video. This is the video, Options Trading for Beginners, the ultimate in-depth guide from Project Finance that I recommend everybody go watch when they want to learn to trade options. I don't try and remake this video because it has 17 million views, and that's because it's so good. Okay. Now I've had a chance to meet Chris Butler in the past and interview him on my channel. Pretty nice guy, but what I want to do on these options deep dives on Wednesday mornings is go through, give you my opinion on what he's talking about, try and add a little context and make it even better for you, right? This is probably the best video on YouTube for options trading for beginners, and we're going to add a little sugar and a little spiciness on the top to make it even better. So, hope that sounds good. Let's jump into this and see what he's let's watch this for a little bit and I'll jump in where I can.
And then the stock price increases significantly, the value of their call option will also surge because the ability to buy shares of stock at the fixed strike price gets immensely valuable as the share price rockets to higher and higher prices. But we need to discuss something that's extremely important, and it's a major sticking point for options trading beginners. And this is that when you are trading options, very rarely will you actually exercise the option to purchase shares of stock at the called strike price and then sell them at the current market.
There we go. So if you remember, we talked about last week how when you buy an option, you're basically buying a coupon to buy the stock later on for a lower price. Okay. When you are buying the stock at a later price or a later time for a lower price, you have the choice to exercise those and actually take those shares, right? You can actually be the owner of those shares. You don't have to. You don't have to. As the option buyer, you don't have to. And I have never once exercised an option. Never once. I don't want the shares. Basically, we're just trading coupons at the end of the day, right? You can buy my coupon from me. I'll buy your coupon from you. We're going to trade coupons around. And at the end of the expiration cycle here, if one of us wants to take the shares, by God, we certainly can. But I've never exercised one, and I don't ever plan to.
Market price, as I just described in this Tesla example. The reason I described it like that is because as an options trader, you have to understand where the prices are coming from and why the price changes make sense. So in the case of buying this 800 call option when Tesla is at $811, if the stock price goes to $1,000, I have a contract that allows me to buy 100 shares of stock at my strike price of $800. So then I could exercise that right, buy the shares at 800 and sell them at 1,000, which would give me a $200 profit per share. But here's the thing. An option will always include the benefit that it provides the owner in its price. So the option price will always embed any profit that can be made by exercising it. So in the
Oh, hang on. Option pricing law. An options price will always include the benefit / profit that it can provide the owner if they were to exercise the option. Okay. I hadn't heard it put in that way. This is new to me, but okay.
example where I buy the 800 Tesla call option and the stock price goes to $1,000, since I have a call option and the call option can buy shares of stock $200 below the current stock price of Tesla, my call option's price will be at least $200. And that's just the price. So if we multiply by the contract multiplier of 100, we get an option value of at least $20,000. Now, it's a law that an option has to be worth at least the benefit that it can provide the owner. And by benefit, I mean if I exercise the option to buy 100 shares of stock at 800 and the stock price is currently at 1,000, the benefit or the profit that I could make by doing so is $200 per share. And that means that the call options price must be worth $200 or more. So in this Tesla example, I mentioned that I could buy the call option, the stock price increases, that I could exercise the call option. But in reality, you would not exercise the call option. You would simply sell the call option at the higher price, and you would make the difference between your purchase price and your sale price. So it's just like buying shares of stock. When you buy shares of stock, Your goal is to see the shares increase in value, and then you can sell the shares at the higher price and secure your profit. With options, it's the exact same thing.
And to that point, we're definitely not going to be watching all 3 hours. Don't stress. Maybe 15 minutes or so at a time. Trying to get through this, but we're making a nice playlist, so it'll all be there. But this is why I tell you guys all the time, right? I'm not worried about the price of the option. The price of the option is going to be what the price of the option is going to be. I care significantly more about the price of the underlying stock, because that will be way more determinant on if I'm making money or not.
99% of the time, when you are trading options, you will be trying to trade options with the goal of profiting from the price changes of the options. Very, very rarely will you actually want to exercise the option, because you don't need to exercise the option, because the benefit or the profit that you could make by exercising the option will be embedded in the option's price. So I really want you to internalize the fact that when you're trading options, you don't have to exercise the option to realize the profit. The profit will be realized by selling the option at a higher price if you are buying options. So really,
Let's use a real world example. So let's do Datadog. This is one that I traded a couple weeks ago. Managed to catch the top tick on it. I mean, like the actual top tick. Unbelievable, right? I tell you guys all the time, you're never going to catch the top. You're never going to catch the bottom. Every once in a while, you get right. So totally nailed that one. So on my option, I had a 106.79% gain, while the price of the stock went up 10%. Now, 10% on a stock is a huge move, right? In the span of 4 days, but I made 10 times that much. Okay. The price of the stock went up 10%. The price of the option went up 100%. Pretty cool, right? This is why I trade options. Not only that, but the capital outlay for these options was significantly less. It was like, God, I don't even remember what it was at the time, like 6% or something, based on the price of the underlying stock. Meaning, if the stock's $100, you could buy it for $6. Now, we'll go more into that later, I'm very sure. But this is why trading options is so amazing. Tremendous gains, huge move in the stock, but 10 times higher in the option itself. And I did not want to own the stock. I never wanted to own the stock. I will never be an owner of Datadog. What's the point, right? Why would I actually care to be a quote long-term investor in this stock when the only thing I want to do is take advantage of these short-term moves? This is the objective here every single time. Let the stock do what it's going to do. Remember, all stocks are bad, and every once in a while they act right. So never worry about exercising the option if you don't want to. But if you are an option buyer, you have the choice.
quickly, if we just want to fact check what I just said, let's look at an option on Tesla with a strike price $100 below the current stock price. That option is worth more than $100.
Oh, this is roughly, let's see, does it show the delta? Yeah, it does. So this one he's doing an example on is an 80 delta option. That's my wheelhouse. It's not always $100 less, but it's deep in the money. And you can see just behind right here, that's the delta column, and it's right at 80 delta right there. So this is a perfect example of what Chris likes to trade.
So that checks out. If we look at a call option with a strike price $200 below Tesla's current share price, that call option is going to have a price higher than $200. So that checks out.
And that's because of the intrinsic value, right? If the price of the stock is 815 and you look at the price of the option, the difference between 815 and 600 is going to be not just the 200 there. It's going to be the intrinsic value, how much moneyness it has, how deep in the money it is, but also the extrinsic value, which is the time value associated with it. So if it's purely intrinsic value, no extrinsic value, that only happens at expiration. Like the day of expiration, the hour of expiration is when it's only intrinsic value, no extrinsic value whatsoever. Surely he'll get into that. I'm getting ahead of myself, but I love the options. I love this stuff.
Out as well. So I want you to internalize that when you're trading options, you do not have to exercise the option to realize the profit. And 99% of the time, you are going to be trading options with the goal of profiting from the price change in the options, at which point you could close your position and you could.
He said 99% of the time. I'm telling you, never once in the history of buying and selling options have I ever exercised because I want to own the shares. So that would be 100% of the time. You never have to do it.
Realize the profit, which will be the difference between your purchase price and your sale price. So let's take a look and see exactly what actually happened with this Tesla call option. As it turns out, the day after I took the first image where Tesla shares were at $811, Tesla was actually higher. So I took another screenshot to look at that same call option with the increase in Tesla's share price so that we could see exactly what happened to that.
Right. So it should have increased by $11. If it went up $11, the price of the option should go up by at least $11, maybe potentially more, because it's now gone $11 deeper into the money. Let's see what he says.
That call option.
No, hang on, just real quick. Look at this bid ask spread. This is one big bid ask spread. It's really difficult to say. It's 78.65 versus 84.75. Surely we'll talk about that later on. But imagine here for a moment that you bought it for 84.75 and you had to sell it back at 78.65. That's $6.10 that you just lost. So that's $610 per contract that you just watched evaporate for the privilege of buying and then selling it back. Now, how much is this in proportion to the actual price you paid for? So divided by 84.75. So you lost 7% on your investment. And this is why the bid ask spread is so important to me. In this example, you would have lost 7.19% of your investment immediately. 7% of your investment just evaporated between buying it and selling it, even if you did it within 2 seconds. That is why the bid ask spread is so important, because you don't want to spend this kind of money. Imagine if you were trying to flip phones, right? Imagine if you were flipping phones and the most you could make is a 10% profit, right? You're buying it from Joe, you're selling it to Corey, and you buy it from Joe for $100. You're trying to sell it to Corey for $110, but you lost 7% of that value between buying to selling. Even if you were able to make that spread, you just lost 7% of your investment immediately. That super sucks. Corey's like, I want to flip some flapjacks. I don't want to flip phones.
Option with the passage of 1 day and an increase in the stock price. So let's take a look. The stock price in this image is now $836, which is a $25 increase from the Tesla share price of $811 that we just looked at a moment ago. So now that the share price is $836, let's go ahead and go to the June expiration and look at the call option with a strike price of $800 and see exactly how that option price changed given the increase in Tesla's stock price. As we can see, the 800 call option in that June expiration cycle is worth $94.10. And if we multiply that price by the option contract multiplier of 100, we get an option premium of $9,410. So if I purchased that call option just the other day and I paid $8,170 for that call option and held it until today, which is a share price of $836, which is a $25 share price increase from when I purchased the call option, now my 800 call option is worth $9,410. So now I could just go ahead and sell the call option.
Hold on, I want to do the math behind this here. So the price of the stock went from $811 to $811 to $836, so $25. But you're saying the call price went from $81.70 to $94. Okay, so $94.10 minus $81.70. So that's interesting. So that means the delta is closer to 50 versus closer to 100. Now, what do I mean by delta? Delta is and I'm sure I am 100% sure he'll talk about this later. Delta is the the change in the options value for every $1 change in the stock. So for example, if it had 100 delta, the price of the option would have gone up by $25. Okay. In this case here, it went up by $12, which is roughly half, which is why I say that's closer to a 50 delta. And so delta is really important, right? Because why would you want to buy a stock or buy an option, watch the stock go up $25, and your leveraged investment go up by half of that? Dude, that sucks, right? That's why I go for the 80 delta. I feel like that's the sweet spot where I'm not having to pay too much in intrinsic value. I'm paying as little extrinsic value as I can. And when the price of the option or when the price of the stock moves, I can capture 80% of that gain versus just 50% of it.
For $9,410. And my profit on that trade would be $1,240. A $1,240 profit on an initial trade cost of $8,170 gives me a return of 15%. But Tesla's stock price itself only increased by 3%.
Oh, there's that leverage we talk about, right? 15% return on the option here versus only a 3% change in the price of the stock.
So this is another benefit of trading options, and this is one huge draw of options, is that they give you leverage. So in this case, we saw a 3% increase in the share price of Tesla, but this 800 call option in the June expiration cycle saw a 15% increase in its value. So the stock price went up 3%, but the call option went up 15%, which means comparing the two returns, the return in the call option was 5 times more than the actual return in the shares themselves. This is exactly how options traders make money. They think that something will happen with the stock price. They put on their position. If that happens, their position benefits by seeing an increase in its value. And then they can go ahead and sell their position at the higher price, and their profit is the difference between the two prices. So it's just like trading shares of stock. If you buy a share,
Exactly. And I see this question quite a lot. Can I apply the golden ticket trading strategy from options to stock? Absolutely. Perfect example right here. You can do exactly that. However, don't even think about being in the same ballpark as me as far as returns. Like, we're playing two different games here, right? You're playing soccer, which is what it's called. All right. American football took over the name football. You're playing soccer, and I'm playing I don't do sports. I'm playing tennis. Like, I don't know. We're playing two different sports here. Okay. One is not greater than the other, but you can't expect to have the same returns that I have if we're playing two different games.
share of stock for $100 per share, and it goes up to $125 per share. You can sell your shares for $125 a share, and your profit is the difference, which is $25 per share, or 25%. So it's the same idea with options trading, except with options trading, you have a more narrow time frame because, as I mentioned earlier, with shares of stock, you have no time limit. But with options, since you have to choose an expiration, you do have a time limit. And because of that, it is a more sensitive activity. But the reason people do it, as we just saw in this Tesla example, is that it can leverage your returns if you are right. So through this example, we learned a few things about call options. First is that the first option type is a call option. The second is that the call option has a strike price, and that means that the call option can buy shares of stock at the call option strike price between now and expiration. So that is what a call option does. And because the call option can purchase 100 shares of stock at the call option strike price, if the share price increases immensely, that ability or value is going to be immensely valuable, because if the share price ends up being $200 above that strike price, then you have a financial contract that allows you to buy 100 shares of stock $200 below the current stock price. And obviously, that's a pretty sweet deal. But also, what we learned was that you do not have to exercise the option to realize your profit, because one of the laws in options trading is that an option must be worth the benefit or the profit that it provides the buyer should they decide to exercise it. So what I mean by that, once more, is that if I buy a call option on Tesla with a strike price of $800 and the stock price increases to $1,000, if I decide to exercise my call option, I will buy 100 shares of stock, $200 below the current stock price. And because that will give me a profit of $200 per share, that call option must be worth $200 or more, meaning that the premium has to be 20.
Right. It must have at least that much intrinsic value. Surely he'll get into more detail about that later. I have no doubt about that. This is going to take us many weeks to get through, which is why I want to start it now.
$20,000 or more. And if you look at any call option and you look at the difference between the stock price and the strike price, the option will be trading for at least that amount, because it is a law in options trading that all option prices must include the benefit that they can provide the owner at that moment. And the last thing that we learned about call options is that they provide leveraged returns. So in this Tesla example, the share price increased by 3%, but the call option that we were looking at actually increased by 15%, which means the return in the call option was 5 times higher than the return in the shares themselves. So everything seems great and all, but I know you're wondering, what's the catch? And there is a catch. The catch when buying call options is that you have to be right about the stock price increasing, otherwise you will lose money on that trade.
This is facts. This is facts. And that's the same with the stock, right? Don't get it construed, because a lot of people get really scared when they say, oh, you have to be right. Of course, just like if you were to buy a stock, if you bought the stock and it goes against you, I'll pull up Apple because I lost money on Apple. It's okay. That's part of the game. I'll pull up Etsy. I lost money on Etsy over here, and then it went up later on. It's part of the game. Okay. Yes. If you buy an option, if you buy a call option, I should say, and the price goes down, like I did on SMCI. Oh, I erased my notes. We'll go back to Apple here. If you buy a call option and the price goes down, you lose money. But it's the same as if you buy a stock. If you buy a stock and it goes down, you lose money. So don't be scared by that. Don't be scared by that. A lot of options sellers, which I'm sure he'll talk about at some point, really sell the sexiness that a stock could go up, the stock could go down, or the stock can go nowhere and you make money. And the sexiness is there. I fell for all the sexiness, right? It was dressed in lingerie and I couldn't help myself. I fell for all the sexiness. But unfortunately, when you sell an option, to me, I have unlimited profitability because I bought that option. You as the seller have unlimited liability on that option. Because if it takes off, right? If it takes off like Datadog, or yeah, we can do Datadog, Robinhood, doesn't matter. If it takes off, right? I made 106% gain on the option I bought. Guess what happened to the person who sold it to me? Guess what happened to the person who sold that to me? They lost more than their possible profit. Let's conceptualize this for a moment. If I bought it for $5 and it went up and I had 106% gain, that means it was roughly $10.20. Okay. That person who sold it to me, the most they could possibly make was $5 because that's what I bought it for. But the most they could possibly lose is unlimited. This is where selling options goes absolutely haywire, because that person who sold me this call lost more than the greatest amount they could possibly ever make on this option. Here I am, unlimited possibilities for them as the seller of the option, unlimited liabilities. And listen, you want to be on the possibility side, not the liability side. Oh, well, good point here, Luca Tubo. For a put, it can just go to 0, so it's not that limited. You're right.
So in the house example, remember that I bought a call option with a strike price of $200,000, and I paid $10,000 in premium for that call option. And remember, in my second scenario, I said that the house price goes to $150,000. But I have a financial contract called a call option that allows me to buy that house for $200,000. But since the current valuation of that house is $150,000, there's no benefit of having my call option because my call option gives me the right to buy the house $50,000 higher than the current market price of the house.
Right. Remember, it's exactly like buying a stock. Options can work against you as well, right?
And obviously, I don't even need the option to do that. If I want to buy the house, I can just buy it for the lower price of $150,000.
I have to stop right here. David, this is an extremely dangerous thing to do. I really appreciate you typing this out, and I'm not trying to call you to the table or anything like that. But if you sell a contract and the price of the if you sell a call contract and the price goes up and you roll the option up, you probably were not able to do it for a credit. Most likely you had to do it for a debit unless you doubled up. And people do this, right? And I'm not saying you did, but doing this as it's working against you continues to get worse and worse and worse. Rather than fixing the problem, you've just extended when you have to deal with it. So I really appreciate you typing that out, David, but this is a dangerous thing to do. It's super, super dangerous. If it goes against you and you just roll it up, hoping for more time, you're not fixing anything. You're actually making things worse. So apologize for having to jump on that. But Dave, I really wanted to let you know that it's a really scary thing to do.
Dollars, which is the current market price. And in that example, I said that my option would be worthless, and because of that, I lost the entire $10,000 premium for buying that call option on that house when the house price did decrease. So there is a catch when buying call options, and that is that you need the stock price to increase.
Right. Exactly. Just like if you were buying stock. This is where people scare this. And I'm not saying that he's doing this, but this is the fear mongering aspect of options. If it doesn't go up, you lose money. Right. Exactly. Just like if you bought a stock. So don't be scared by people saying that. Dave says he only rolls for a credit, never roll for a debit. Okay, that's good. That's good. Never, ever, 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 ever roll for a debit. That means you're taking on additional risk.
Otherwise, you will lose money on that transaction. And we'll talk very in detail later about why buying call options or buying options in general will lose money if the stock price does not change. But for now, I want to focus on teaching you the basic option trades and how the two option types move with the stock price and how traders actually make money when trading options. I need some water. I just talked a lot. All right.
I get that. All right. Let's take this all the way to another 4 minutes or so, and we'll wrap it at that point here. I'm trying to do it in like 15-minute chunks.
Let's keep going. So let's go ahead and really quickly look at an example where a call option trade does not make money because the stock price falls. And we'll see exactly what happens to the call options price as that is happening. In this image, we are looking at the shares of Adobe, which has the ticker symbol ADBE, and we are looking at the shares on May 6th. On this date, Adobe shares closed at $362 per share. Let's say a trader thought that the upward trend in Adobe shares would continue, so they went to the May expiration cycle and they bought the 380 call option. So the call option in the May expiration with a strike price of $380.
Okay, so they're buying it out of the money. Okay. Actually, what I'd also like to do is go to OVTLYR and let's go to this point in time to give a little perspective on what OVTLYR would have said. Now I got to go way, way, way back. We got a buy signal on the SPY today, by the way. Let's go to ADBE. I believe we have this data in OVTLYR. So this is, I'm really sure this is in 2020. So May 6, 2020 is what I'm looking for here. Got to load the all button here, which is going to take a moment. And then I got to zoom it all the way over here. The more data that pulls through, the slower it gets, just so you'll know. That's why we loaded it 1 year. That way it runs a lot faster. Okay, what date was that? May 6th? May 6th is specifically this candle right here. Specifically this candle. right? So it's in an uptrend. It's getting more greedy in the stock. The sector, however, is coming down in greediness. Sector breadth, which I'm in the way, sector breadth actually is bearish right here. So while it did have a buy signal, this is what I tell you guys all the time. You're looking for more than just the signal on its own. So this came on the 7th, so a day after that point. Getting more greedy, buy signal, uptrend. However, the sector is pulling back on greed. The sector breadth is super bearish at this point. So for the outlier 9, right, and I'm not even looking at the market. This is only about halfway set up for me. So I would not be taking a buy signal right here. Even though it came with the buy signal, you need to look at the whole market in general, not just your stock in a vacuum.
And let's look at a chart of that exact option so we can see how the option price changes as the stock price is changing side by side. On May 6th, the May 380 call option closed at a price of $1.92. So that means the premium or the value of that option is $192, meaning that if I wanted to buy one of these call options, I would need to have $192 available in my trading account. So let's say a trader buys this 380 call option and they pay $192 to enter that trade. As we can see, the option price initially jumped higher as the share price continued higher, but then unfortunately things turned around, the stock price crashed.
Well, hang on. You can still buy here and sell here. You can still buy here and sell here before it pulls back, right? Don't get suckered into somebody saying, oh, you're so dumb because you bought it right here and then it goes down later. You can take your profits in 1, 2, 3, 4 candles, just like I did right here. 1, 2, 3, 4 candles. Okay. You can do that for sure. Just putting that out there.
And with it, the call options price decreased as well. The very last data point on this call option chart, the option only had 1 day left until expiration. And with a strike price of $380 and with Adobe shares significantly below that at about $355 per share, the 380 call option with 1 day left until expiration was essentially worth $0.
Okay, cool. I'm glad you talked about this. Let me pull up my slides. You're going to like this. See, this is why I wanted to go through these videos, because we can learn a lot through his examples and then my actual experience, right? This is not theory, this is reality. So when you buy an out of the money option, this option was the 380 option he's talking about here. Out of the money means that it's higher than the price of the stock, okay? And a lot of brokers make it easy for you. They'll do some sort of shading or whatever, right? This is out of the money. The yellow line is at the money. The blue shading is in the money. You only get paid if you're in the money. See, the intrinsic column here starts really high and then gets lower and lower and lower and lower, and then it has 0, okay? You're only going to get paid on your option if you hold it to expiration if it goes in the money. Now, looking at this, the 380 call was about $20 out of the money, okay? So that would be equivalent to Palantir over here, right? About $20 out of the money, okay? Now, at expiration, it's worthless. At expiration, it's not that it's lost value. Let's get this really, really clear. When you buy a stock and it goes down, you lose value. If you buy an option that's out of the money and it goes down, it doesn't just lose value, it goes to nothing. Imagine you spend $192 per one lot and it goes to nothing. Right? It's hard to conceptualize this because we're used to stock, going from $150 and then I can sell it at $140. I still get my $140 back. No. You bought it at $192, you get nothing. This random coin. Hang on, I saw a coin around my desk somewhere. Hang on. Yeah, there's a quarter right here. I don't know where this quarter came from, but this quarter is worth more than the price of that option. Do you understand what I'm trying to say here? You don't buy it at 150, sell it back at 140. You lost $10, no big deal. You bought it at 192, you get nothing. Nothing. It's like Willy Wonka. You get nothing, sir. Good day. 0. This 1/4 has more value than that option. That was something I struggled with. I didn't understand. Yes. That's it exactly. You get nothing, sir. Zip, nada. You lose, son. Yeah. So where I wanted to go with that was right here. This is the difference in a leveraged investment, a smart investment, versus an out of the money YOLO call, an out of the money lotto ticket, basically. This is where I play, where it's deep in the money, and only 10, 15, 20% of it is extrinsic value. Whereas when you buy it out of the money, all of it is extrinsic value. So in this case here, all of this is extrinsic value. Extrinsic value goes to zero on every stock, every time, always, forever at expiration. However, the intrinsic value is calculated by the difference in the price of the stock and your strike price. That is where I play. This is where losers play. Your choice. Play on the winner's side of the field or the loser's side of the field. That's your choice. Most people do not understand that they can play on the winner's side of the field, but it costs you more, right? It costs you a good amount more. Because if we go, let's do $10 on either side of the current price, okay? If I'm buying the 135, it'll only cost me $1.85, okay? The 135 strike is only going to cost me $1.85. But if I go to the 115, it's going to cost me $12.45. It's going to cost me significantly more, right? $12.45 versus $1.89. However, all of this will decay. That's what I'm trying to show right here. All of this will decay. Every single bit of it will decay to zero. Every single bit of this will decay to zero. However, my option over here, only about 10% of it, 15% of it will decay to zero. And that is a function of options that we cannot change, right? So you just got to live with that. You got to live with that. So looking at these two charts here, this one decays slowly and smallly per day. This one decays slowly and then all at once. And then all at once. Very, very, very big difference here. So this out of the money option made money for a minute and then went to zero. Big difference here. Whereas my option, if I had bought it in the money, would have made money and it would have decreased in value, but it certainly would not have gone to zero.
It was just a couple pennies, but essentially that means that the option is worthless. We'll explore exactly why this happens in just a little bit, but for now, just understand that if you buy call options and the stock price decreases and is below the call option's strike price, as the option gets closer and closer to expiration, the option's price will steadily approach $0 or being worthless by the time of expiration. And that's because if the stock price is well below a call option strike price near expiration, there is little value in having that call option because traders don't need the call option to buy shares of stock.
Right. There's no point in having this 135 call if the price of the stock is 125, because why would I want to buy the stock at 135? I just go out in the marketplace and buy for 125. However, there is value in having my 115 because I can still buy the shares of stock at 115 when the price is trading at 125. Do we see how this is all working together? Pretty cool, right? I'm really glad we're able to do this. We only got about another minute left.
So if I bought this call option initially for $192 and a few days later, the stock price was way lower, the option was close to expiration, and the option was worth only a couple pennies, then I would have essentially lost 100% of the premium that I paid for that option. Since if I buy something for $192 and its value falls to zero, I have lost everything that I put into that position. And if I held this option through the expiration date and the strike price is $380, but the stock price is below $380 when the option expires, I don't have to do anything because the option will simply disappear from my account as it will expire worthless, and I will be left with the full loss of $192 on this trade. All right, let's take a quick breather because
Okay, yeah, we're also going to stop here. However, I did see some chatter in the chat talking about a trade Theo has on. So Theo, I'm scrolling back up through the chat because I wanna give you my perspective on it too, if that's all right. Chris, I bought 5 contracts that expire on May 21st. That was last week. Okay, so it's already expired. Of NBIS call options. And okay, you bought it on that date and they expire on 6/6. Okay, so let's do this. We're gonna work through a real life example here for Theo. Oh, that's all right, Theo. I got you, my bro. So NBIS. He's looking on the 6/6. He has the 35s. Okay, that's where I would play too, by the way. At $6.50. Okay. So he's currently down 17% at $5.40. If I am not into the green by May 30th, should I exercise the right to buy the options? Well, that's up to you, right? Do you want to own NBIS? That's your call, right? I can't make that call for you. You've got to decide, do I want to own the stock at $35? I don't know. Your choice. I mean, let's think about conceptually right here. It says he bought it for $6.50. So $6.50. So 650, 6.50 plus the 35 means that his break even would be at 41.50. If the price is less than 41.50, which is at $40 give or take right now, then no, for sure not. There's no advantage to doing this. Now remember, that's because he spent $6.50 on the option and he bought the 35 strike. So his break even point here, if he were to exercise, would be at 41.50. However, let's say the stock was at $50, right? Now he can exercise the options at $35. He still spent $6.50. That's gone. And then he can spend another $35 and the stock is now at $50. So actually that would make sense. However, at this point, this would not make any financial sense to exercise the options because your total price in the trade is greater than the total price of the stock right now. Does that make sense? That's a great example. Thank you, Theo, for allowing us to talk about it. You're welcome, my dude. I got you. Theo says, yes, but we 6 times. Right. Let's just focus on, don't worry about the multiplier, right? How many contracts? We're just focusing on the one because it'll apply to every contract size. Okay. Makes sense. Very, very cool. Glad I helped you. Oh man, I gotta tell you, I watched several Skyview trading videos and I wanted to barf at one point. I don't remember. Oh, should I do it? Should I do it? Do you want me to do it? Hang on. Skyview trade. We're gonna do it. I feel like barfing this morning. Hang on. It's their most popular video. I've done this video on its own as a video. This one here. Oof. This one's so brutal. We're gonna watch this together. Well, get your barf bags ready. Like legitimately, this was probably one of the worst videos of all time that I watched, that I did a reaction to. And it has 2.5 million views. And I'm telling you, I'm building it up too much, I know. But I was flabbergasted when I watched the video because it says why 90% of traders lose money. Okay, let's see it.
Bill Gates and Warren Buffett both agreed that Charlie Munger is the most intelligent person they know. Charlie Munger once said, "Problems frequently become easier to solve if you turn them around in reverse. Unless you're more gifted than Einstein, inversion will help you solve problems." Now, let's use a little bit of inversion to solve your trading problems. Around 90% of traders lose money. So what we have to do is ask, what are...
This is facts. I tell you this all the time. 90% of traders lose 90% of their accounts the first 90 days of trading. It is fact.
90% of these traders doing? First, they buy breakouts and they sell breakdowns. Yes, they're literally chasing the stock price.
Right. So what he's trying to tell you is trend following is stupid. Okay. So first off, he's 100% wrong because you will only get paid if prices are going up. It is facts.
Around. Second, they all try to cut their losses short and let their winners run.
Okay. So another problem. This is the worst. Man, here's what I'd rather do. I don't want to go through this again because it's just going to make me mad. Go to my channel. Hang on. You know what? No, I'll even do this one better. Let's hang on. Why 90% of traders lose money? I don't know if you knew that. You can actually. Okay, this is a 4-minute video that I spent 49 minutes losing my shit over. That's how bad I don't want to do that again. Coincidentally, I'm wearing the same shirt and jacket and hat in that video. That's pretty funny. Go watch this one. I can't do it. I can't do it again today. But maybe we can watch it of me reacting to a video that I've already reacted to. We could definitely do that later for sure. But listen, this afternoon, one of our outliers sent me his trading plan to give my perspective on. I would really appreciate it if you could come and watch live, because I'm going to break it down in every possible way that I can, and not to be ugly or mean, but to help him, right? Give him my perspective. Because as we talked about at the very beginning here, right? Do not ever feel guilty about trading your own plan, but my plan will be different from yours. And because of that, you need to make sure that your plan fits for you. All right, listen, have a fantastic day, but don't forget to click one of these 2 videos, only if you want to save time, make money, and start winning with less risk. We'll talk soon.